Chapter 15, The Cost of Home Ownership. The first learning unit discusses the types of mortgages and monthly mortgage payment. We'll take a look at the different types of mortgages that are available to consumers, utilize an amortization chart to compute the monthly mortgage payment, and calculate the total cost of interest over the life of a mortgage. I really like this chapter because, like I said, this is a important topic that many of you will hopefully do one day, as it's considered the American dream to buy a house. So it's really important to understand different mortgage options available to you and how your monthly mortgage payment is calculated. So figure 15.1 shows you the different types of mortgages that are available. Back in 2007, there was a lot of foreclosures because of a type of adjustable rate mortgage called a subprime loan. This type of home loan allowed buyers to have very low interest rates, sometimes even a zero rate. This helped customers qualify for expensive homes that they would not otherwise have qualified for. Lenders offering subprime rates assumed prices of homes would rise, and most buyers would convert to a fixed rate before the rate was substantially adjusted upwards. As we know now, prices of homes fell back in 2007 to 2010. So that caused a lot of problems in the housing market. The most common type of mortgage is this 30-year fixed rate mortgage. A 30-year fixed rate mortgage has a predictable monthly payment. The advantage of that is if interest rates go up, you're locked in at a lower rate. Disadvantage is if the interest rate falls, you're locked into the higher rate unless you refinance, and there are fees associated with refinancing. A 15-year fixed rate mortgage is the same in that the monthly payment is fixed, but the interest rate is normally lower, but your payment is also higher and a larger down payment is needed. So you build up equity faster because you're not paying as much interest in a 15-year mortgage. A biweekly mortgage is another option that's available. This means that instead of every 2 weeks or 26 times a year, the bank receives a payment. By paying every 2 weeks instead of once a month, mortgages can tend to be paid off faster. You build equity twice as fast. An adjustable rate mortgage, or an ARM, you have a lower rate than fixed. If rates fall, your rate could be adjusted down without refinancing. However, your monthly payment could go up if interest rates rise. It's a little bit riskier than a fixed rate mortgage, so you have to ask yourself, how much are you willing to risk your payment going up? A home equity loan is an accessible line of credit backed by the equity in your home. You can borrow against the equity in your house and then make repayments back. If you don't pay those back, however, you could have your house foreclosed on. They also have things called reverse mortgages. Under a reverse mortgage, senior homeowners borrow against the equity in their property, often getting fixed monthly checks, and the debt is repaid only when the homeowners or their estate sells the home. So computing monthly payment using an amortization table. You can calculate the principal and interest of a monthly payment using an amortization table as shown in table 15.1 and using the following steps. This is the same type of amortization table we used in chapter 14 for installment loans. So take the amount of the mortgage and divide by 1,000. Remember, if you put something down, take that away from the sale price. We're only concerned about the amount you financed. Look up the rate and term in the amortization chart. At the intersection, there is a table factor. Multiply the amount in step 1 by the amount in step 2. So in the example that we're following, a man named Gary bought a house, and the house mortgage is $160,000. So $160,000, and his interest rate was at 9%. So you see his table factor is 8.05, 30 years at 9%. So Gary bought a home for $200,000. He made a 20% down payment. The 9% mortgage is for 30 years or 360 payments. What are his monthly payment and total costs of interest? First, we have to determine how much his mortgage was. He actually borrowed $160,000. He made a 20% down payment, so he's only financing 80%. So 160,000 divided by 1,000 equals 160. Our table lookup, like we just said, was 8.05. So 160 times 8.05, his monthly payment, not including taxes or insurance, just his payment on the loan, is $1,288. So to calculate the total interest, as we remember from chapter 14, it's the total of all monthly payments minus the amount of the mortgage. If he's making 12 monthly payments for 30 years of $1,288, he's going to totally pay $463,680. His mortgage was only $160,000. So over the life of the loan, he's going to pay $303,680 in just interest. Now, I do want to point out that this example in the book is a little, dare I say, outrageous. Interest rates on houses are not, at this moment in time, typically at 9%. They're closer to the 5.5% range. So this is just a really large amount of interest. Example, compute the following amortization chart using table 15.1. Selling price of the home is $160,000. You make a down payment of $20,000. Your interest rate is 3.5 years for 30 years. So we want to calculate the principal or the loan amount. We need to determine the payment per 1,000 for the table lookup, and then determine his monthly mortgage payment. This is a much lower interest rate than what we just saw. So if the selling price was $160,000 and he put $20,000 down, then the loan amount is $140,000. Payment per 1,000, take the $140,000 and divide it by 1,000. Go to your table lookup and look up 3.5% at 30 years. So you get your table lookup of $450. $450 times $140, his monthly mortgage payment is only $630. Big difference compared to the example we just saw. Now, lenders typically, when you're paying on your house, you don't just pay the loan. You're also required to pay taxes and insurance. So when this is all added together, it's called PITI, principal, interest, taxes, and insurance. So the 4 steps for calculating the PITI are to calculate principal and interest as we just did, so that in the previous example, the principal and interest amount is $630. Determine 1/12 of what the annual property tax is supposed to be. Determine 1/12 of the annual homeowner's insurance, and add all 3 of those numbers together to get the monthly PITI payment. Lenders typically require your PITI to not exceed 28% of your gross income. And your debt to income ratio should not be greater than 36% total. So not just your mortgage, but any other car loans, student loans, anything else, should not be greater than 36. Remember, regardless of the amount of the loan you are offered, avoid being house poor. Don't buy more house than you can reasonably afford. The banks are going to tell you that you can afford a monthly payment, and it may be higher than what you're comfortable with. So don't just go for the max amount that you're qualified for. Make sure that you're going for a payment that you are comfortable with. So in Gary's example, Gary's monthly principal and insurance payment is $1,288. Sorry, that should say principal and interest payment. There. Gary's monthly principal and interest payment is $1,288 from when we calculated it before. His annual property tax is $2,345, and his annual homeowner's insurance is $1,578. What are his monthly PITI payments? Well, we know that he's going to have $1,288 for principal and interest. Then we need to add his annual property tax and his annual homeowner insurance together and divide by 12 to get 1/12. So $1,288 plus $326.92, his total payment is $1614.92. It makes a big difference on the interest rate. Just a 2% interest rate increase in your monthly payment of just the principal and interest makes a $236.80 per month difference. Over the life of the loan, that comes out to $85,248 in difference in the loan, just with a 2% interest difference. Let's look at comparing loan types on monthly payments. Compare the effect of the monthly payment and total interest of selecting a 15-year versus a 30-year term for Gary's mortgage loan of $160,000. The 15-year monthly payment is $1,624 and the 30-year monthly payment is $1,288. So we see that there is a significant difference in the monthly payment amounts between the 15 and the 30 year. So in the 15-year, if his monthly payment is $1,624, he's making 180 payments. That minus the original amount of the loan of $160, his total interest cost is $132,320. Remember, with the slightly lower payment for 30 years, he's paying $303,680. That difference, that $336 a month difference, cost him $171,360 over the life of the loan. There are other costs that are considered hidden costs in purchasing a home. The first are closing costs. Closing costs include fees for credit reports, recording costs, lawyers' fees, points, title searches, etc. A point is a one-time charge that is a percent of the mortgage. 2 points means 2% of the mortgage. So it's the mortgage, not the selling price, but the actual loan amount. An escrow account is an account that the lending institution requires each month 1/12 of the insurance and 1/12 of the real estate taxes to be kept in this special account. The monthly balance in this account will change depending on the cost of insurance and taxes. Interest is paid on this account. You also have repairs and maintenance. And when you're buying versus renting, you're in charge of paint, wallpaper, landscaping, plumbing, electrical, things like that. Whereas if you were renting, then your landlord would be responsible for it. The last thing is what's called PMI insurance. When buying a house, if you do not have 20% in cash for down payment, lenders require you to purchase PMI, private mortgage insurance. This can be very expensive and only benefits the lender. It's important to know that as soon as 20% equity is reached in the home, as determined by an appraisal, the borrower must petition to have the PMI removed. The mortgage lender does not keep track of this, and you may continue to pay PMI after it is no longer required.